Hi guys, it's Bogdan here from System Traders. This is our first episode of the series we call the Holy Grail Trading Strategies of YouTube Debunked. Today we will be looking at a strategy promoted by one YouTuber that we won't name, where he combines the RSI with a 50 threshold and stochastics to enter and exit trades. I'm sure you can find the videos yourself. His strategy, at least to our understanding, is if the RSI is below the 50 threshold and the stochastic crosses under the upper threshold, then he goes short. If the RSI and the stochastics are both oversold at the same time, then he exits the trade. We can safely assume the opposite would be the logic for entering a long trade. So if the RSI is above the 50 threshold and the stochastic crosses over the lower threshold, then he would go long. And if the RSI and stochastics are overbought at the same time, then he exits the trade. He then goes on to cherry pick one example of a short trade from the 3rd of March 2020 on Amazon on the hourly chart. If we carefully analyze even his own peak trade, we can see that the RSI has actually crossed over the 50 line shortly after his short signal. So that would indicate a change in the direction, meaning he should reverse his position. But naturally he just ignores the signal because his whole example wouldn't make any sense. Towards the end of the video, he's also adding a MACD as the third oscillator on the chart just to fit his confirmation bias. We won't test this scenario as it is redundant and will not add anything to the trading strategy. He's also using mental stop losses, and this is hardly quantifiable, so we are going to ignore them in our testing, for reasons that we'll explain later in the video. Now looking at the theory, the relative strength index, the RSI, is a momentum indicator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the asset price. Being a momentum indicator, we can definitely use it as a filter to determine the trend. But he's sort of mixing filters and triggers. The Stochastic Oscillator is also a momentum indicator that's comparing a particular closing price of a security to a range of its prices over a certain period of time. It is used to generate overbought and oversold trading signals, utilizing a 0 to 100 bounded range values. In essence, he is using two similar momentum indicators to enter and exit a trade. We don't fully understand his logic simply because he ignored the trend reversal signal on purpose, just for the sake of his example. But let's go on to the results of the backtest. As we mentioned before, we're using ZoroTrader for implementing our strategies. So looking at running the RSI and stochastic strategy from YouTube on the Nasdaq on 1 hour since 2010, we'll see that its maximum drawdown was close to 150%. Just to make that very clear, that is a margin call. Also, the total downtime is 97%, so you would only be over water with your equity curve 3% of the time. This is obviously just trading one lot of the Nasdaq. Number of trades, it's going to just above 500 at 48 trades a year, and its percentage of winning trades is 56.4%. One could think, well, if I'm winning 50% of the time, surely I'm making money. Well, this is a very good example that that's not the case. So the annualized return is minus 9% with a negative Sharpe ratio because of it. If we have a look at the annualized standard deviation, which is a measure of risk, it's about 30%, and that's quite a lot. Naturally, since it's only traded on one instrument, it's sort of expected. That's quite well reflected in the fact that it's lost money 6 out of the 11 years. And if you can notice, in 2015 it's lost 52% of its equity. Some years it just broke even, like in 2018, but most of the time it simply lost money. Let's have a look at the actual equity curves. As you can see, the Nasdaq one is quite unbearable. We also decided to give it a go on some more instruments, so we tested it on gold and on US oil. Even though it has a win rate close to 60%, it loses money in all three cases. We can safely conclude the strategy has no edge and it is failing on all the instruments that we tested it on. So what is wrong with this strategy? Well, to start off, this is not a strategy. It's just a poor extreme example of overfitting. Not only that, but it's not even respecting its own logic in the example provided. Second of all, it's not explicit what kind of market inefficiency is trying to exploit. It's pretty much an oscillator soup that could produce results out of pure luck, but there is no idea behind it. The creator simply picked a trade off a chart and created a holy grail trading strategy based on it. Thirdly, it has rules that can be easily bent. For instance, he's ignoring the crossover of the RSI above the 50 line just to create an example. This is not even an example of overfitting, it's misleading on purpose. Fourthly, the strategy should test the most important rule first, in this case the field set. If we think of the RSI's position in relation to the 50 line, that is our main entry into the logic. Then some triggering logic needs to be applied, say stochastic crosses over or under the thresholds. As a rule of thumb, the exit logic should be the opposite of the entry logic. Fifth, stop losses are added mentally without a clear definition of what they are. We need to find out if our strategy is just lucky or there is some actual inefficiency to be exploited. Hence, in the first steps of the development, we aim to be 100% in the market, so there are no stops or trails added. They are added at a much later stage. So is money management. So, is there a way to improve this strategy, one might ask? The answer is yes. If we are trying to speculate the momentum of an instrument, there are many ways to build upon this inefficiency, using the RSI or some other momentum indicator as a starting point. Will this strategy work on all time frames and all instruments? Well, probably not. There is a very high risk that if it does, in backtest, it is overfitted. So can you use the RSI with the 50 level? We'll just give you a hint. If you increase the lookback period, you will get a less sensitive momentum indicator that could catch larger trends. We at System Traders are a group of passionate developers and traders with a combined experience of over 10 years in the development of trading systems. Besides training our own strategies on our own portfolios, we are also developing bespoke strategies. Although it seems simple, building, testing, and running a strategy is not easy. The only way to be able to successfully run it is to know what to expect from it in the future. We can help you backtest, develop, and run your own strategy on stocks, forex, and futures. Feel free to get in touch for a quote on developing your system. We are happy to run a backtest for an indicator of your choice for free if you leave a comment with the name of the indicator, the instrument, and the lookback period. If you like this video, please give us a thumbs up and make sure to subscribe so that you can follow our series.